All right, this is being recorded. One thing I mentioned to everybody at the beginning of all of these webinars is watch it again. First time through, it's going to kind of blow by you in a sense where you're going to have questions. You're not maybe going to follow exactly how I trade. You may have heard how to trade this strategy before somewhere else, but I'm going to have different nuances that I really focus on. So, you know, some of those things might be catching you off guard. When you watch it again, you'll actually remember it for a much longer time than you would if you just were to watch it once as well. So give it a shot, watch it again, and test my theory. So this is going to be medium volatility strategies continued, long put calendar, all right? Now, one thing I mentioned during the long call calendar webinar as well is when I set up this syllabus or set up this educational series, I probably should have put the calendar closer to number one in the medium volatility strategies because it is one that we can't completely isolate the volatility like we could necessarily with the diagonal. So therefore, we're leaning towards the lower to medium volatility, and I should have had that set up so when we do it, it kind of goes lower, medium volatility, and medium to higher volatility along the curve, which would have made maybe a little bit more sense down the road. But we can still do this with medium volatility. One of the caveats, even with a low, if we entered this in and around a low volatility underlying, is that we do need the expectation of volatility increasing going forward. Now, of course, we're in an environment where we're seeing some wanky things going on with the volatility, and I'll talk more about that a little bit later. But, you know, right now is a great scenario for this strategy because we have higher implied volatility in the front months than we do in the back months. And usually volatility affects the further or longer duration options contracts than the nearer ones. But what we're seeing is a bit of an anomaly going on right now in the overall markets. Front months are really getting jacked up. Marina, glad to have you. It's no worries. We haven't gotten too far. But one thing I do mention to everybody is watch it again, even if you watch the whole thing all the way through. Watch it again because it will help it stick into your long-term memory, and I think you'll understand it a little bit better as well. All right, so having said that, without further ado, we're going to be talking about creating the long put calendar. I'm going to go through this step by step, you guys. So I have specific rules, and what I'm trying to do with all these rules is get rid of all of this second guessing yourself, like especially right now. I mean, even the talking heads on TV are second guessing themselves and their strategies and things of that nature. What I try to do with these strategies is break them down into their minutia, into the little tiny steps that we can go through one by one, go through our checklist. If it fits all those parameters, then we're good to go with it. We know that we are entering this with the highest probability of success, okay? So that's what I want, is to have you guys be able to have the highest probabilities of success. And that's what I've done with this whole syllabus. Every single strategy I go through has specific rules that you need to follow, all right? And when you do that, it takes the stress out of all this trading. If it works, it's working. If it's not, it's not. You know, you're in, you're out, all right? So we talk about how to do that as we go along. But I got to get a couple of things out of the way real quick. First of all, my name is Eric Wilkinson, and some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Started out trading in college with some money I had earned, and after graduating college, just went straight to Chicago. I packed my bags, jumped in the car, drove to Chicago, and started working on the floor of the Board of Trade as a runner, and then moved up, sold all my stocks, and started trading in the pits. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options, basically on all these products in all market conditions. So I've seen worse market conditions than we've seen today or this week. Also, you guys can follow me on Wolfman's blog, or follow me on Twitter at Wolfman's blog, or follow our parent company at ProTraderStrat. I do daily market commentaries in the morning, and I talk about the trades that I put on or took off. I usually do that in the morning. And then later on in the day, I will put on trades, not as often, but we'll put on trades and take them off. If I do that, I will notify everybody on Twitter, just because I want you guys to be able to follow along at home as well. I don't want you to, especially if you're following along and don't want to have to wait till the next day to find out what I've done. I'm not saying that you should follow me. I'm just saying that we need to read over this disclaimer, to be quite honest. And it says any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and or associated companies or employees is provided as general commentary. Does not constitute investment advice. The reason why I can't give you investment advice because I don't know your risk parameters, most importantly. And actually, this might be actually as important as I don't know what's in your portfolio. And if I don't know what's in your portfolio, how could I possibly ever give you a recommendation on something? It just does not make any sense whatsoever. So bottom line is, do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right. We've already mentioned this long put calendar moving forward. So the long put calendar is simple as a horizontal spread, okay? And the reason why it's a horizontal spread is when you think about the option montage, which the option montage is nothing more than this page right here, the trade page, all of this stuff. These are the option montage. And what we're doing is when you go out in time, you know, think about that as the horizontal, and we're picking the same strike. So it's just a flat line on the expirations, basically. So at the end of the day, it's a horizontal spread. It's not a diagonal spread, because a diagonal spread goes out in time and hits a different strike, right? We've already learned that one. Horizontal is we go straight out in time. Okay. So in that, you know, I wrote this up backwards because I have a tendency to quote everything from the front month, despite the fact that a lot of people say you shouldn't in options. But when I was doing options in Fed funds, we quoted everything from the front to the back, and that's how it was. And so 20 years of me thinking that way is very hard to get out of that that cycle. So a lot of times with treasuries, that's what happens. All right, so what we're doing is we're selling the at the money, or what I prefer is just slightly out of the money, near expiration put, okay? And then we're going to go out further in time and buy that same strike that is at the money or just slightly out of the money, which is what I'm going to be looking for. Usually the at the money is kind of like the 45 delta, 45.50 delta, and out of the money I would consider up to, like, you know, a 35 delta is where is about as far out as I'm going to go with this strategy. If we go too far out, our probabilities start diminishing quickly. So I want the probability of the one that I'm buying, I want that probability pretty high that it's going to be in the money, right? I want this one that I'm buying to go into the money, but not necessarily the one I'm selling. So we get just a little bit out of the money and try and get clear of that for at least the next couple of weeks for the most part. All right, so essentials to success. This is what I'm talking about with the checklist. We have to go through this checklist every single time to determine if this strategy is appropriate for the checklist here. And picking the right environment. This is going to be one of the most important things to discern on any strategy we look at. For this particular strategy, picking the right environment means that we need, for one, low to medium volatility. All right. The next thing for the right environment in and around this is we need to have the volatility coefficients for the underlying to be very close to one another. So for instance, let's just look at Budweiser. And it's not going to, a lot of stocks right now are the anomaly, okay? Because we're seeing all this volatility in the front months, we're seeing an anomaly. So with this strategy, I usually talk about, or with any strategy, I talk about like red light, green lights, things of that nature. A green light is when the volatility between the 2 months we're going to be trading are within or less than 2 percentage points increase. So that would mean that this January, the volatility over here on the side says 35.71. Our limit would be 37.71 to fit this rule on the one that we're buying. Well, you can see it's lower. That's an automatic green light. Anytime the volatility we're selling is higher than the one that we're buying, that's a good thing. All right. It doesn't matter what strategy you're doing. If you can sell higher volatility than where you're buying, then what it means is you're selling that volatility that's really high and you're buying volatility that's low. Okay. So that is a good scenario. You always want to be selling high volatility and always want to be buying lower volatility. So this type of setup is perfect and it's a no-brainer. It's an automatic green light. It's like a neon green light. It says, trade me in a sense. So I would not be surprised if I put on a lot of trade. I'm completely flat in my portfolio for the most part besides eBay. And I'm going to be looking to add some of these because the setups are too good. Even if I'm wrong, I could still be doing okay with these. So it's almost a layup on a lot of these. So for my rule would be that it's got to be less than a 2% increase. So from 35 to 37. If it goes down, it's automatic. It's good. A yellow light would be an increase of 3 to 4 percentage points. So it'd go from 35.71 to 38.71 and a yellow light being limited at 39.71. Anything greater than a 4% increase in difference, which would be, you know, basically anything above 40 here would be a complete red light. Move on. There's other strategies we can find that are more appropriate for that type of environment. Okay. So our rule here is less than a 2% increase in this volatility coefficient. Obviously, if it's a decrease, that is better than a 2% increase. Okay. Hopefully nobody's confused there, but this scenario is a green light because it decreases going out the curve. But on an increase, our limit is 2% for a green light, 4% for a yellow light, and anything above 4%, just get out. Don't even move on to another strategy. Okay. So that's picking the right environment. Also, one thing to note is we want to have good theta decay, but I'll talk about that more about the duration. So the next one is picking the right underlying. Now, you guys may trade all kinds of stocks. You know, there's thousands of stocks out there. I have about 150 stocks over here that I look at. But one of the rules that I follow, and it really is one of those rules to even make it over into my watch list, is on a stock under $100. And this is also around normal, you know, markets. Right now, we've seen high volatility for an extended period of time, and traders are getting a little tired, if you will. So my rule of thumb on stocks under $100 is the bid ask on the closest expiration. For instance, this is 29 days to expiration. That's the spot month is what we would call it. It's basically where the most time and volume is being transacted. It needs to be 10 cents wide to the bid ask. Now you can see Budweiser doesn't fit that rule. And a lot of these stocks in and around this environment are going to get a little wider because we're seeing really high volatility across the board. And what that means is when there's high volatility, guys, it means these guys making markets, and you included, when you're putting in orders, they're making their markets a little bit wider because there's a lot of levers and pulleys going on in the markets. And if I am selling, if I am a big trader and I'm selling or just making markets. So if I'm just making markets in Budweiser, if I sell that call, I am probably going out to buy the stock to hedge my risk. Okay. That's what big, corporations do. These big, BNP Paribas, BNP does, I can't pronounce the last part of it, but BNP, all of those big trading houses will have these traders when they're making markets in this, they're offsetting their risk, they're hedging it. So when the market's moving back and forth, the underlying is jerking back and forth like we've seen the last few days, then they have to make their options markets a little bit wider because if I get hit on my calls, I got to run over there and buy the stock. And in that time, the stock may have moved. So in order for me to cover my rear end, I need to make that option a little bit more expensive for you to buy to cover my risk to run and buy the stock. Does that make sense? Because the stock's probably not going to be in the same place as when I sold this call. So that's why the markets will get a little bit wider, because people aren't willing to take on that undue risk in volatile markets, right? And I suggest you guys do the same. The market will hit you. You know, I've talked about time and time again, when you're putting trades on, never go straight to the mid-market or hit the bid or lift the offer. Always work it a little bit, because there's a lot of things going on in this market we may not see, and you can get better pricing. That's especially true right now. So you just have to make that decision. Do I want the penny by squeezing this trade for an extra couple pennies, or do I want the trade? You know, sometimes you just want to bang out the trades and get filled right now. And I have no problem with that. But if you're, you know, a lot of times I want the penny, because over the course of our lifetime of trading, those pennies will add up. All right. So rule of thumb for the picking the right underlying: under $100, 10 cents wide. Over $100, basically you're going to take the decimal point and move it 3 ticks to the left. So here we're going to go 1, 2, 3. 16 cents wide is how wide the bid ask should be in the option montage. And these aren't, a lot of these aren't going to follow this rule right now because of the big volatility we've seen lately. And with this volatility, people aren't leaving orders in. And I hope you guys aren't leaving GTCs in all the time anymore right now. And that is also a part of it. People aren't leaving the orders in there. So after the market, like we are right now, those orders have been canceled. So what we're left with is who's still leaving orders in there overnight. Okay. Does that make sense for everybody? Right now, we may not be seeing the real market. People aren't leaving orders in there to be picked off. So it's a little bit wider, but during the day trading, move this decimal 3 ticks to the left on a stock over $100. And that's how wide the option montage should be. If it's $1,000 stock, move it 3 ticks to the left. The bid ask should be $1. So that is my rule of thumb for a green light. Now, if you're used to trading, say, you know, Budweiser, which may not have a 10 cent wide market, but you're used to trading that, I have no problem with it being, you know, 15 cents on a stock under $100. But just be careful and know that, you know, you're taking on a little bit more risk. That would be like the yellow light, you know, under 10 cents for a stock under $100. That's a green light. Up to 15 cents, I would say that's a yellow light. You know, 20 cents or more would probably be a total red light for me. Okay, so that's picking the right underlying. Make sure you have tight bid ask, because that will show us where the volume and open it, you know, when there's a lot of volume and open interest. So you can see with Budweiser, there's some decent open interest, but not a whole lot of volume in here. And we go and look at something else that's a $60 stock, just to try and compare apples to apples. We can look at Walmart. It's not really, but 10 cents wide should be our rule of thumb. Generally, Walmart will fit that rule. But you can see here, you know, these markets on a higher price stock are tighter yet even. And you can see there's a lot more volume on any given day. There's a lot of eyeballs in that market. Okay. So that means you have a better opportunity to get filled at a good price when there's a lot of people stepping over one another to try and be on the market, right? If I'm 50 cents bid and you come in 52 cents bid, well, then I'm like, I'm off the market now. I go 53 cents bid because I want it to be, you know, my order that gets filled. Now you go 54 cents bid. Right now it's 54 cent bid at 56 offer, right? We've tightened the market. Free market price discovery has gotten us because we got a bunch of eyeballs in there. If it's just me in there, I'm basically 45 bid at 55, right? You know, I'm just as wide as I want to be. You come in 50 cent bid, I'm like, I'm at 55 still. All right. So if I'm the only player in town, I know that I'm making the markets really wide. you're going to have to come to me in a sense. Okay. And picking the right duration. The right duration is really key to this because we want to exploit volatility, or we want to exploit theta decay in the front month and take advantage of the lack of theta decay in that further duration. So we're going to be looking at right around this area here. That's the option expiration in the front month. And you can see this is a theta decay representation of those stocks, or of those strikes we're going to be selling, right? We're going to be close to at the money. So this is a pretty good representation. And you can see that the theta decay really eats away at those premiums quite dramatically in the next 28 days. Whereas you go further out on the ones we're buying, you don't get that theta decay. And that's what we want to take advantage of. Slow theta decay here, the one we bought, and the fast theta decay in the one that we're selling. So picking the right duration, the one we're selling, we want to be as close to 38 or 35 days to expiration as we can. And on the one we're buying, we want to be out here in the 60 to 70 days to expiration, if at all possible. Even further is fine as well. All right. And then picking the right strikes. And, you know, with that duration, remember, always keep in mind that duration between those 2 months needs to be pretty tight on that volatility. All right. Picking the right strikes. That's pretty easy. All right. We're picking the same strikes, Wolfman. We don't need to have, well, yes, we do a little bit, because this comes into our directional assumption, right? Obviously, if we're entering the long put calendar, it's a long duration option strategy, and we're buying a put in that long duration option strategy. We're pretty bearish long term then, right? So picking the right strikes is going to come down to, do I believe that this market is going to tank tomorrow, or do I believe that it's going to, maybe I like to get on a scenario like today. I was hoping we would get a little bit more of a higher settlement, because that would indicate to me that we were maybe going to get a dead cat bounce. If you've ever heard of a dead cat bounce, that's what we're really looking for for the long put calendar. We would want a dead cat bounce, where the market, after we put this strategy on, gets a lift for about a week. Let's say we hit a bottom, we get a lift for a week, and this is called the dead cat bounce. It's like you've taken a big drop, like we've seen, then the market bounces, and it's like a fake out rally, and then slams. So that's something we would like to see, where we get a bit of that bounce, and we get that front month theta decay happening. It gives us enough time to get that theta out of the front month and get that premium erosion, and then get out of it and watch the market free fall. All right. Because then we got that long put on for very little money, and it feels like it's on for free in a sense. But picking the right strikes. So if we are in the camp that I'm talking about, looking for the dead cat bounce, where you think, okay, we've seen a little bit of a bounce, then go closer to at the money, or like that 45 delta I was talking about. I never really picked that 50 delta, which is truly at the money. I like to get a little bit further away. That 45 delta still gives us a very high probability of success. But if you think that we are going to continue in this bearish trend, where it's going to lockstep continue down, start moving out a little bit further to maybe the 35 delta or the 36 delta, okay? Because then it gives you a little bit more play and allow that theta decay to eat away at that front month. So if you're more bearish, get a little bit further out of the money. If you're thinking closer to more of like a dead cat bounce, or we've kind of hit a bit of an extreme here, feels a little oversold, but I think that the market is still in a bearish trend, then go closer to at the money. Okay. Does that make sense for everybody? All right, good. Looks like everybody's got it. If you got any questions, one thing I always say is ask your questions while you're thinking of them. I'm not that guy that makes you wait to the end of the webinar to ask questions. I want to make sure everybody's clear a concept before we move on. And if it's fuzzy to you, it's going to be fuzzy to somebody else. So I want to make sure everybody out there is clear of concept. All right. So knowing your exit strategy before entering the trade. And one thing I mentioned with all of this about being mechanical before I get into the actual exit strategy, all of this has to do with being mechanical, right? Sticking with these rules. And one of the ways to stick to the rules is write them down on a piece of paper, you guys. I have spiral notebooks stacked up right here next to me from all of the trades that I do, because I write them down on a piece of paper and I put why I put them on, what the environment was, why I thought that was the right environment for this, the duration I picked, and my exit strategy, most importantly. But I write all those things in and around that so that I have data to go back and look at. Is this what has been working? Has anything changed? Why didn't this work out from why my original thesis was? Okay. If you write it down, you're more likely to stick to it. Your brain might start tricking yourself into, squeezing this out a little bit longer than what you originally said. And that's usually when things start going wrong. All right. So know your exit strategy before entering the trade. With this on the loser, I'm going to write it out. Okay. Debit spreads, things of that nature. When I get into them, I know my risk and I'm pretty comfortable with riding that risk out. If my thesis change or if my market assumption changed from bearish to bullish, then of course I would jump off this train. I'm pulling this out immediately. But what I'm talking about is knowing what you're getting yourself into beforehand. You can even do it when you're writing it down, like, all right, if it rallies to this point or breaks this Fibonacci, or if it, I get the 200-day and the 50-day crossing over, that's where I'm going to get out. Follow those entry and exits that you normally use if you want to and you're comfortable with them and you found success with that. Stick with that, right? So on this strategy, if it broke up above a resistance area, and that's normally where you would get out of a bearish trade, get out of that. I don't have a problem with that, okay? But on the winning side, what we're looking for here is an increase in our position by about 30% of value. And usually when we're doing this strategy, we're paying about $1 for it. Maybe let's just say we're paying $1. That's usually around, $100 stock or something like that. We'll end up paying around $1. We're paying about $1. So when it increases to about $1.30 would be the first indication to get out, lower risk parameter person. That's what I'm thinking of for this strategy on this exit, because, if this is one of the first times you're taking my class, I can't necessarily assume you have a high risk tolerance. So a 30% increase is really what I'm looking for on this strategy. That's going to be about, somewhere that would be the green light for you. If you want to squeeze it out for a yellow light, I would say go to the 50% and get out. It's going to be very difficult to achieve full max profit on this. I mean, within the duration of that front month and within the duration of having this full strategy on, because you really have to nail the number and it's a little deceiving. So it may look like you're going to be able to pay $1 and your max profit potential is $2, but it is very, very difficult to get all that $2. It will almost never happen. But a 30 to 50% increase in that value of the premium you paid is very realizable, and within the duration of this strategy is very conceivable. So stick with that. A 30% increase. If you have a higher risk tolerance, I don't have a problem with you going with a 50% increase, okay? Do you always use monthly expirations or weeklies? Okay. 7, I usually use the monthlies. And the reason why I use those monthlies is because that's where the most eyeballs are, right? But something like Apple has all kinds of participation in those weeklies. Just stick with that rule that I had with picking the right underlying. If you're using those monthlies, it should still follow along that same rule of having a tight bid ask, okay? But I have no problem with you rolling, especially this short put that we're selling. You can roll that out a couple of times through those weeklies if there's good participation in there. And by the time you're to this long put, you could have it completely paid for, right? By the time you're in that monthly cycle and it's the spot month, you could have a free put on. So a 30% increase for a lower risk tolerance, 50% increase in value for a higher risk tolerance. All right. So our max profit I have here is unlimited. The reason why is if you let that front month put expire worthless, or you take it off for a very little, you know, for a nickel or something like that, which I would suggest anytime you can take off a short option for a nickel, as you're, you know, to take off that risk. It's not worth riding that extra duration out for the extra nickel. As far as I'm concerned, I'd cover it. But if you get out of that short put, your profit is unlimited to, you know, zero is really your limit to the downside, but it's going to feel unlimited as a stock goes from 100 to 0, which you probably won't see happening during the duration of your stock. But in a sense, it could be unlimited. One thing we're looking for here is when we're setting up this strategy, one of the things I probably should have talked about with the essentials to success is our risk reward on this. And what I usually do is I'm looking for risk one to make one. So if I risked $1, I paid $1 for this underlying. Remember I said I'm looking to make $1.30, that 30 to 50% increase. If I paid $1, I'd get out at $1.30 or $1.50. But what I want to set this strategy up is if I risk $1, I can make $1. All right. And if you can make or risk one to make two, that is a home run scenario. Okay. But you want it to be at least, if I'm risking $1, I can make $2. All right. Or at least make that dollar. If I paid $1 to get in, I can get out for $2. Okay. All right. Max loss is always the net premium you paid on a debit spread. This is a debit spread, right? When we're putting this strategy on, it's going to always be a debit spread because that longer duration has more theta in it, right? We're still picking out of the money options, but that longer duration has more theta in it. It's worth more. We're always going to be paying a debit for it. So that is always the risk, is the debit we pay, which is why when I put it on, knowing my risk, I'm usually just going to let those debit expire worthless or become a winner. All right, I'm not usually going to exit early is what I'm saying on a loser. Now our break even is our long put option minus the premium paid. So if we pick the 100 strike, then and we paid $1, then our break even is when the underlying is trading $99. Okay, so our break even is the strike minus that premium we paid. Break even is always going to be to the downside of our strike. It doesn't mean, and this is at expiration too, you guys. It doesn't mean that it's not going to happen earlier. If we see volatility expand and all kinds of other things happen, we could see our break even actually uptick a little bit, come closer to where our strike location is as volatility expands and premium expands, okay, for us. That could help us. All right, so this is the time of the webinar. I usually throw it out to you guys. Throw some stocks in the questions box. That's how I've been communicating with some of these people if you've heard them asking questions. So throw some stocks in there and we'll run through these to see if they fit my rules. And somebody first off threw Foot Locker out there. So we're going to look at Foot Locker. We have under $100 stocks. So my first rule is pick the right environment. So the right environment for this underlying is to have about an IV percentile of somewhere between 30 and 50, 30 and 60. That works. 40 is great. So that works. The next thing we have to look at is these two volatilities. Does this volatility stay within 2? Yes. You can see that it actually decreases quite a bit. 2%, 2.5 percentage points. It decreases. That is better than an increase. Our rule is it's got to be better than from 44.67 to 46.67. It's got to be inside of that. That works. Another thing you guys might be asking is, can we do this in and around options? Yes. If the or in and around, earnings. If this month that we're buying has an earnings in it, yes, that is good. That works. We would expect volatility to expand in and around that earnings. So that's okay. When we're buying an option and we expect volatility to expand, that's a good thing. That always helps us out. So you can have a earnings in the one we're buying. One thing to note, though, if it's a winner heading into that earnings, cover it. Get out. I don't care how much of a profit you have, get out. Because after that earnings event, you're going to have all this volatility come out of it, and that's going to erode your premium dramatically. Like the market might not even move, and you would see all of the premium come out of your strategy. All right. So stay away from that. If it's a winner, cover it. If it's a loser, I'm more likely just to write it out. Like full boat loser, that puts basically for free. That's where I'll write that out. But yes, you can have earnings in this one. Stay away from earnings in the one you're selling. All right. We don't want an earnings happening in that one we're selling. All right. So Foot Locker, not a whole lot of volume and open interest in here. It's very close to fitting that rule. It's 15 cents wide on these. And during open market operations, it might very well fall within that rule. So it fits everything else. Let's just check to make sure it doesn't have that earnings. It's not going to have the earnings. They just had it. So picking the right duration, we made sure the volatility is down, the right duration, 29 to 57. We're still within that curve that we were looking at. So that works. So the one we would be buying is like right around that 35 to 45 delta is the sweet spot. So, you know, depending on how bearish you are, it's the pick 'em between these two, right? If you think you're getting a dead cat bounce, you go to this one. If you think that it's going to continue to slide, you pick the 36 delta. All right. So that would be up to your market assumption. To me, it looks like I would pick the closer to expiration here. It's right at the point of control. So I think it'll settle down there. Therefore, I'm going to play with this one. So this, the 43 delta. So we sell the 48 strike, go out to the February, try and buy the same 48 strike. We don't have it. That becomes a problem. We would have to go out to the 46 strike, which I'm not very happy about. Oh, I don't even have, or the 45 strike. So I'm just not even going to do this one. The strikes aren't going to work out for me. I'd have to go into the money for it. I'll probably just walk away from this one because I can't get to the strike locations I want. I'd probably play a different strategy around this one. All right. So another one somebody threw out was Walmart. So let's take a look at Walmart. Delete this. So Walmart has about a 50 IV%. You can see it over here in my watch list. The other place you can look at it is right here. So 56, we're okay there. Next thing we look at is this less than a 2% increase from 29.09 to 27.84. Since that decreased, that's a green light. So we're working on that one. Does it fit the rule of tight bid ask? It's under $100 stock. Should be 10 cents wide. Usually it is during the open market operations. You can see some of them are still. So I'm okay with that. I trade Walmart a lot, so I know that it fits that rule during the day session. Duration, we have heavy theta decay up here. You can see the theta on these options that we are going to be trading. Right here is -4, and then the theta out here on the one that we're buying is less. It's -3, so we're exploiting more theta decay than we're receiving. So that's a good thing. Again, we're going to get these funky strikes, but we have the 87.5s. It's close to a 50. I like to go a little further out, so I'm going to pick the 85 strike. We sell this one and then buy the 85 strike here. All right. That works out 78 cents. That looks pretty good. You know, it's not a huge one. And Seven, I think, was asking about, somebody was asking about the monthlies. This would probably be one that you could play with the monthlies. You know, it's going to have, as long as it has tight bid ask in there, right? You can see right now they're really wide. So if it's this wide, then I'm probably not going to roll it out through the monthlies. Next thing to look at, one of the things I talked to you guys about was making sure if you're risking one to make one. So we're risking 78 cents to make one would be make 78 cents. Well, we're risking one to make two, right? Risking 78 cents to make $1.60 something. That is a very good scenario. So this works out quite nicely. Now, we would want this market to kind of trade sideways. You know, if you guys watch my daily market commentaries, you see me talking about the market profile over here all the time. And when it gets in and around the market profile point of control where these lines are, it wants to settle down. That's where a lot of time and volume's been spent. That's where people are comfortable. So it should settle down there. That's why this would be a good scenario. Maybe it's going to settle down here for a minute, allow that front month option to decay worthless, and then I get my fall down to test the extremes. All right. Does that make sense? All right. So that one's a good setup. As a matter of fact, I might look at that again tomorrow to put in my portfolio, to be quite honest. All right. Somebody else, OIH. I don't ever trade this one, but let's see. It's taking a tank, $13 stock. It's got super high implied volatility. You can see on the chart just by looking at it. So this is at 100% implied volatility percent. So when I'm talking about middle of the road implied volatility percent, I'm talking about this volatility, implied volatility percent for each individual underlying. I'm not talking about the VIX. This isn't the volatility I'm talking about where you get like middle of the road 30s. That's not what I'm saying. What I'm saying is every stock has its own implied volatility percent. That's what I'm looking at. And the way to figure out implied volatility percent for an underlying, if we look at OIH, it's going to make the math very easy for me. What you do is you take the current implied volatility. You have a numerator and a denominator. In the numerator, we take the sum there and divide it by the sum in the denominator. In the numerator, what we find the sum of is the high, or the current is minus the low, and you take that sum and divide it by the high minus the low. And you can see here it's going to give us 1, which is 100%. If we take something like AIG, for instance, what we do is we take where the current is 46 minus the low here of 13. So we have 33 in the numerator, right? 46 minus 13 is 33 in the numerator, and divide that by the high minus the low, which is 73 minus 13, 60. So we have 33 minus 60. That gives us right around that 55 implied volatility percent. Okay. So that's what I'm talking about for a medium volatility, medium to low implied volatility. It's around each individual underlying, and each individual underlying has its own implied volatility percent. All right, so FXE, I'll go with that one then. I know this one's going to have tight markets, right? 7. So tight markets, we need to have inside of 10 cents wide, or you know, you could go 11 cents wide, right? Move it 3 ticks to the left. That's about 11 cents. You can see that this fits that rule. ETFs usually do. Medium to low implied volatility, we got that. So we're going to be looking at the 39 delta. That one's right middle of the road. That's the one we're going to sell, the 109 strike. Go out. We got to go out a little bit further than the February because they're not, you know, basically on Monday we'll have February monthlies. But right now we don't have that luxury. So we're selling that one. And then we're going to go down here and buy the other 109 strike. So this is a horizontal spread, right? We're going out in time flat to the same strike. Now we're paying a 52-cent debit. So one thing to look at also is our risk reward, right? And the easiest way to do that is pull this strategy up and drop that old thing that I had in there. So we're risking $52 to make $52. So that is a risk one to make one. That is a green light still. So that works. And we've got the time horizon. One thing I forgot to check was the implied volatility percent. And you can see that or the implied volatility is within 2 on this one. You can see it does increase going out the curve as one would expect. So, but it increased by less than 2%. This would be one that I could implement on Monday if I were bearish. It looks like it's kind of topped out. It might be a good time to implement that one as well. The risk for the short put, remember that because you've got that long put, and that long put is longer duration, there really is no risk on this short put. If somebody puts it to you, then yes, you're going to be like, oh, well, Wolfman, yeah, I did have that risk on the short put. Well, you have the long put to counteract it, okay? You can assign somebody the other one. So basically, you can just flip it at the same strike level, right? So yeah, you do have risk of being assigned on that short put, but your capital isn't any more at risk because you've got that long put to cover it. And it's longer duration. So the longer duration long put is going to expire after your short put expires, right? So you don't necessarily have the risk of the short put. But having said that, that's, Banu, why I would never trade a short put calendar. I'm not even going to teach it because I don't agree with that setup. Why would I be buying Theta Decay and selling, a longer duration without Theta Decay? Doesn't make sense. You have too much going on, too much risk way out the curve. So stay away from that. All right. All right. Somebody else threw out Home Depot. Let's check out Home Depot. We don't want earnings in this cycle, so we got that going for us. We want middle of the road. Maybe this might be a little bit high. It's a $160 stock. So we want to move it 3 ticks to the left, 16 cents. It's outside of that, but just make sure during the day session it is inside of that. We can look at volume and open interest and see there's pretty good volume, decent open interest. So one would expect that. Let's just assume we're during the day session and we got those tight markets. We want to look at the deltas. So we got a 36 delta here. That's when we're going to look to sell. I like to sell that one first and then go out and buy the same strike at the 160. So we're paying $1.87, or sorry, $1.85. Let's just look at the risk reward on this. Make sure we're risking one to at least make one. And we can see we've got $1.85 we're risking to make $200 or $350. We're making more than we're risking. That's a good thing. So that works. Now, I don't have any problem whatsoever, right, letting this front month expire, covering it for, a nickel or half the value, something like that, and riding this one out. If you get that dead cat bounce and you're like, okay, I feel like it's a dead cat bounce, Wolfman, we're going to drop out, and you cover that leg out, this one in that regard. I don't really have a problem with that. I usually would let this expire to ride this put out and leave it on as a strategy. Take it off as a strategy is usually what I like to play it as. I don't like to leg in and out of stuff because 50% of the time you leg into something better, 50% of the time you won't leg into it better. But the 50% of the time you don't do it better, it's going to be a lot worse than all of those 50% of the times that you did it better. You're going to be, getting it better by a penny or two on that 50% of the time. But the time that you lost on it, you're going to be missing out on like nickels and dimes. So I put it together as a package, take it off as a package, or let that one expire and not worry about it. Okay. Anybody else have any questions before I move on? Good stuff today. All right. Well, then that's it for today. Then you guys take advantage of this. It's over in the chat window, you guys. I'm going to send that out to you guys right now if I can find it. Give me a second here. If I can find my cursor. I think I put it out there. There it is. I sent it out to you guys. And basically, what I try to do in all of my webinars is take the guesswork out of it for you guys. I try to make it package very simple. So when you make it simple and you have steps and guidelines to go by, there's not all of this questioning yourself, second guessing what's going on. Was I right? Did I do the right thing? Am I smart? Am I stupid? All these crazy things that you start banging your head up against the wall. Hey, listen, we're going through the steps. If I do these steps, I follow Wolfman's advice on these, I have increased my probabilities of success. I have set myself up for success. Therefore, you will be more confident. We know where we're getting in. We know where we're getting out. There's nothing else to think about, right? That's how I teach in all of my webinars. And that's what I talk about in the daily market commentaries, you guys, is go with your gut in a lot of these things because, you know, we're all pretty smart guys. You know, you're just as smart as the next guy. And when you get that gut feeling, what that is it's your limbic part of your brain that doesn't have speech, but it's where everything gets processed. And that gut feeling is that part of your brain that's telling you, hey, do this, but I don't have words. I can't form words to tell you. That's a different part of our brain. Okay. That's the part of our brain that does reasoning. And we can reason ourselves out of our gut feeling. But I will tell you guys, 99% of the time, your gut feeling is dead on, and go with it. If your gut ever tells you something, don't second guess it, you guys. Because yes, you will be able to use the outer brain to come up with other reasons as to why your gut's wrong. I would lean to say your gut is right. Okay. So if you've learned anything about, you know, how I teach, or if you've taken anything away from this at all, you guys should take advantage of this, because literally I'm trying to take the guesswork out of it and make you guys more mechanical. So for 36 bucks, you guys can't beat it. The best way to become a better trader, you guys, is to constantly learn, which you guys have clearly done that, clearly made that decision to become a better trader by attending this webinar. So wouldn't you say that just knowing how to create a long put calendar, going online and looking at Investopedia on how to do a long put calendar isn't going to be enough to create consistent winners? All right. It's not. You have to have all of these other things that I teach in and around strategies in order to be more profitable, in order to be a higher probability of success. All right. And that's what I teach, is how to trade the probabilities, become more mechanical, and get ahead in the game. Anyone can teach you how to build this strategy. I'm not going to lie, but I teach the probabilities, how to play those probabilities. When those probabilities have gone against us, how we can stay mechanical in order to increase the probabilities even further in our favor, which is the only real way to create alpha, you guys. All right. You've heard people talking about creating alpha. This is the way to create alpha, and that's with options. You can't just go out and buy stocks, create alpha. There's no alpha to be had. So when you're using the right tools for the right situations, you're going to be more productive state of mind, be able to put on more strategies. That's going to create confidence, or create more opportunities, which actually creates more confidence, to be quite honest. All right. So take advantage of that link. It's over there in the chat window. If you're watching this on tape delay, you're just going to have to pause it and punch this into your URL to take advantage of it. All right. I see a couple questions come up. I'll hit you guys here in a second. Give me a second here to finish this part of it up. Just want to thank you guys all. In later webinars, I'll drill down on different option components when and where I find those appropriate. Also, here's the link that might be a little bit easier to read. If you want to pause and punch this in, that probably will work out better. Thank you guys all for watching. If you have any questions, contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. But seriously, guys, take advantage of this. You know, we're in an interest rate environment that's increasing. The Fed said they're going to increase 2 more times this year. I think they've already overdone it. I've already been saying that in the daily market commentaries and on Twitter, to be quite honest, for a couple of months now that they've overdone it. And of course, they did it again, trying to be the Grinch that stole Christmas and increasing interest rates around Christmas time. That's a brilliant idea to crimp spending around interest or around the only time of the year that retailers can make money. So take advantage of that, because you have to protect that portfolio. If you've looked at a portfolio over the last year of bonds, it's been getting beat up. So take advantage of it. 36 bucks, that one alone will pay for the entire series. And there's over 10 hours of videos and more than 10 trading videos too. All right, so that's all I got for that. So take a look at that. Try and click on that link there, and I'll get to these questions in a minute. How about BWA? Is that a stock, or are you saying something for what I was saying at the end there? BWA. I don't think I've heard of this. Oh, Borg Warner. I have heard of this. I haven't traded it, and I can't even tell you how long. So let's just take a look at it real quick. BWA. Sorry. It's a $30 stock, a little bit wide right here. I haven't traded it in quite some time. One thing, if you haven't traded it, just kind of look at this and say, is there a lot of volume and open interest? No. And the reason why I stay away from this is because, like I said, even though it's only this wide, there's maybe one guy in here making the market. You know, you can see there's not a lot of open interest. It might be one guy's total order. So if you come in, 115 bid, he might not budge. He might even move away as the market's, going in his favor, right? He knows he's the only cat in town. He sees somebody coming in. He's like, oh, you're 115 bid at 130, right? So stay away from that kind of scenario. You might have to bid all the way up to, $1.23 to get this guy to trade with you. All right. So not a lot of volume and open interest, and you're going to have to be more lucky than good to get out of this one. So I'd stay away from it. I like that about Dr. Limbic. Thank you. All right. So I surely hope you got your bride something very nice, Santa Wolf. Of course I did, Rick. I had to. Otherwise, it would be a very long winter. So hopefully the missus will be happy. So we'll see. You guys go out there and get your significant or insignificant others, better halves, something nice as well. Go out there and make them something, to be quite honest. Would be something cool, which is what I used to always do, is take like lessons on how to do something going into Christmas and then make something for Christmas for everybody. I have a really funny story about making Christmas ornaments one year, and my wife and I did, I'm going to tell a story. If you guys want to roll, you guys can, but this is a funny story. So we made Christmas ornaments, made glass balls, right? You ever pick up one of those glass balls? Like you blow on them and they break, right? Well, when you're making these things, it's very hard to tell how dainty they are or not dainty they are. Well, we made about 50 of these things to hand out to all our family. And literally, if you drop one of my Christmas ornaments on your toe, you are going to lose a toenail. And I gave one to my grandmother, and she hung it. She couldn't hang it on her Christmas tree because she always had her live Christmas tree, and there wasn't a limb strong enough to hold these things. So she hung it on her chandelier, and the chandelier would hang at a 45-degree angle. They were so heavy. But they look good. So that's my Christmas story for you guys all. So it's going to chuckle about my my cannonball Christmas ornaments over the weekend. All right, that's it for it. You guys take care. Have a great weekend. And if you can't take that, take it easy. Thanks, Andrew. Appreciate it. Appreciate all of it. Thank you guys for all the kind words. Take care. All the best, Rick. Thank you, Marina.